fiscal policy measurements, I would like to give you a backdrop on what's the contemporary macro framework which we need to navigate and to understand about the fiscal space. So when I speak about this, this is of course macroeconomic uncertainty, and this uncertainty is very difficult to measure. So the moment we talk about the uncertainty of COVID pandemic, you must have read in the recent newspapers that the taper tantrum is going to bounce back, and its impact on the emerging economies may be huge. So those kind of policies are also over there. We need to tackle the moment we think about the fiscal space. And why do I say this? Because in order to tackle the impact of the taper tantrum is to have your macro fundamentals correct. And when we talk about our macro fundamentals, we need to work with the interest rate policy. We have to look into our inflation. We have to look into our current account deficit, and of course the fiscal deficit. But right now, as fiscal space or the fiscal deficit, that determines the fiscal response policy package. So you understand that from the recent Union Budget 2021-22, the fiscal deficit is above 9%. It is about 9.5% of GDP, and that was not the fiscal rules-based norm that we need to, as per the norm, we need to keep our deficit, at 3% of GDP. So when there is a pressure on keeping the macro fundamentals strong, especially in the context of, international monetary macro pressures coming on board, we need to see that, what exactly is the pressure? After the global financial crisis, what happened is that over the years, US Fed Reserve, they are trying to reduce the balance sheet of the Fed Reserve by reducing the asset purchases, or indirectly speaking, there may be a rise in the interest rate by the Fed US. Of course, we have seen that in the Jackson Hole, that economic symposium, there was an indication by the Fed Reserve Power Chair, Jay Powell, that there will be an increase in the interest rate, but of course not in the near future. They are going to have a gradual approach to this, tapering process. That's why it's tapering. But, there will be repercussions of that decision on emerging economies. That is why we investors and we economists look forward to the minutes of FOMC, that is, the Federal Operation Committee, Open Market Committee. It's like our MPC, the Monetary Policy Committee. Their decisions are very crucial for an emerging economy like India. That's why we were looking into this August and September, just a day back. Their deliberations were over, but they have not started that normalization procedure, or they are going for a huge containment of the or the reduction of the balance sheet of Fed Reserve very soon. But we have to wait for the next FOMC meeting in November, and my hunch is it is going to happen only in 2023. The raising the interest rate or not, to avoid the capital from being flighty, Indian government has to now start working on their macroeconomic fundamentals, and of course the fiscal deficit is high. So this is the backdrop. And otherwise, what could be the other policy measures in which we can respond to this taper tantrum? Why this a tantrum? Because there could be a huge impact on the emerging economies. That's why even if it's a gradual process, it's going to be it. So we responded to it after the global financial crisis in 2013. We responded to this uncertainty by going for a lot of capital controls. Of course, we have not used our forex reserves to respond to this crisis, but on the top of that, if our macro fundamentals are not correct, then the repercussions will be huge. That's why we need to be mindful about our fiscal deficit. So that's the background. Otherwise, on the monetary policy side, whatever it takes to, that was a narrative in which, Dr. Shaktikant Das has floated many, economic stimulus packages from the monetary policy stance, from the monetary policy side, and the huge liquidity infusion has happened, and there was a kind of, regulatory mechanism which was put on board, and also they have reduced the policy rates, from a huge, 5% over the years. Over the MPC meetings, we have reduced it to 4%, and that is status quo in the recent 2-3 MPC meetings. And now there is a policy uncertainty because our inflation is going beyond the comfort zone, in the sense we have the inflation targeting, which is flexible inflation targeting on board, and our policy rates are pegged on the basis of inflation expectations, and of course the deviation of our inflation anchor from expectations, and our anchor is 4%, and of course we have the band plus or minus 2, so the comfort zone is 6, but it's little above that. But the argument and the justification by RBI is that we don't have to fear about it because these are supply side. This may be due to the supply chain disruptions and due to the transitory nature of hike in fuel and food items. So we don't have to be really fear about these transitory inflation. So that's it. Otherwise, if we increase the interest rate, then there could be a clash between the fiscal policy makers and the monetary policy makers, because you can understand that in the communication, in the policy tools, what is relevant is the fiscal and monetary policy coordination, because we do remember the tug of war that happened always between the North Bloc and the RBI to have the rates lower, because always government wants the rates to be little lower because that only can stimulate the economic growth. But if the inflation is going beyond a point, then the RBI is in a dilemma to go to increase their rates or not. But right now, if you look at the MPC meetings as well, the communication is that economic growth is the priority, because it's a pandemic-ridden economy. So economic growth recovery process is very crucial. So they are not going to raise the interest rate at this moment. So the interest rate is kept at status quo. But at the same time, if the monetary policy transmission mechanism is not operating, then these policy rates, that transmission into the other rates by the commercial banks, that's a huge issue. But right now the monetary policy transmission mechanism is of course operating, and we can see the impact of that if the moment you look into the credit deployment statistics and its impact on the sectoral economic recovery. Then what the recent statistics, we were waiting for that credit statistics on Friday, and the recent credit statistics, that showed that despite all these liquidity infusion methodology we have been doing over the period of time since March 2020, if you look at the credit deployment stats, of course, small and medium term enterprises, there could be there could be a huge increase, a disproportionate increase in the growth rate of the credit. But if you look at the large firms and if you look at the infrastructure sectors, you can see that the credit deployments, that story is now partial. It's not yet complete. Here the question of that narrative, that deficit is huge right now. It's beyond a point, and of course it's not within the threshold limits. But how can we communicate that this is good for inviting the private investment? Because the narrative what was floated in the Union Budget 2021 was that, of course, the deficit is high, but capital infrastructure investment was given emphasis. And in the times of COVID pandemic, the emphasis was given on the health sector infrastructure, strengthening health sector infrastructure as well. And of course, these two narratives are welcome because this is a dual crisis, and we have the health crisis and of course the financial crisis or economic crisis. So in order to prevent the health crisis mounting into the humanitarian crisis or into the macroeconomic crisis, we need to strengthen our investment in the health sector. vaccination is the predominant way to prevent this from mounting into the kind of macroeconomic crisis. But of course we have also done some kind of non-pharmaceutical interventions like lockdown strategies, physical distancing, social distancing, travel restrictions. But non-pharmaceutical interventions, they don't have a prolonged impact on the economic recovery, as much as the pharmaceutical interventions and vaccination can have on economy. So the narrative of strengthening health infrastructure in the Union Budget 2021 is welcome. So our fiscal space, of course the deficit has mounted beyond a point, but our fiscal space that is getting substantiated or justified by focusing on growth recovery through emphasizing on the capital spending. But of course you can understand that our national infrastructure plan, how the financing plan that center, state, the PPP model and the foreign capital participation, that financing route, that there is an ambiguity over there, but we can listen to government in the future. Maybe in the near future they will come up with a a little more transparency regarding that. But all what we can understand from the 2021-22 budget is that the emphasis there is there on the capital investment, and there is a positivity on that, because if you look at the determinants of private investment models, whether it is foreign capital or the corporate investment, then what is a significant variable over here? It's not interest rate or inflationary expectations or macroeconomic uncertainty. In the models, in the empirical evidence on the determinants of private investment, what we have identified is that, even I have a paper, I have written it with econometrician Rishikesh Vinod and my colleague in IMF, Mr. Karen, and we have identified that public investment, especially public infrastructure investment, is very crucial in getting the investors' confidence and in getting the corporate investment back on board. So if that is the case, even if you have high deficit, you have to communicate that this is the prime emphasis is on your capital formation in the economy. So that's one thing. But there are policy uncertainties and policy conflict over here, because the external environment, if we are getting the pressure from the Fed Reserve in the early 2023 in terms of they hiking the interest rate, then in order to prevent the capital from being flighty, we have to work out with our macro fundamentals, and that's of course crucial. Now let's look into the numbers, what exactly has happened in the 2021-22. What was the policy narrative? Let me give you a punchline. There can be a debate on this, and we can open up the floor after maybe half an hour, after me highlighting the points which I want to do. So here the punchline is that if you have a high fiscal deficit, there is no fiscal cost if you can substantiate with output gap reduction, or as I mentioned earlier, if you increase your private investment. And we understand that monetary policy stance has got limitations in triggering growth through liquidity infusion, and of course to the status quo policy rates, because it is not one-to-one that you reduce your rates and you are going to get your economic recovery back V-shaped or U-shaped, or back to the pre-pandemic convergence. Here the fiscal dominance is crucial, and of course these are extraordinary times, and there is a fundamental rethinking globally about even the efficacy of fiscal rules in dealing with this pandemic crisis. In the sense, do we need a strict numeric threshold ratio of deficit? Is that discipline, is that fiscal discipline growth enhancing in nature? This is a question. And you can also take a look into the chapter 2 of Economic Survey 2021, where Krishna and his colleagues, our chief economic advisor and his colleagues, they mentioned about the public debt sustainability narrative. He highlights the perspective of the eminent macroeconomist Oliver Blanchard by saying that if the interest rate paid by the government is less than the growth rate, then intertemporal budget constraint facing the government no longer binds. So that's the stand which we have taken, and from this perspective, as announced in this Union Budget 2021, allowing a high fiscal deficit to GDP to 9.5% to support the fiscal space for the pandemic recovery packages, that is welcome. So when I mention 9.5% of GDP, of course it's not entirely for the new pandemic packages, because there's an issue of budget transparency also over there, in the sense, there are off-budget borrowing that's happening in the economy through public sector enterprises and the corporate bodies, which are not the part of fiscal deficit. So this year, a bit of those kind of off-budget borrowing is included into our deficit number. So the deficit number shot up to 9.5. We cannot, when you decompose it, we cannot say that it is exclusively due to the new expenditure priorities to tackle the pandemic. Of course, there are elements of revenue uncertainty over there, and there are elements of the budget transparency. Of course, that's a welcome thing, that budget transparency and incorporating a part of deficit which were not transparent is now into this year's deficit number. That's welcome. That's okay. But the point here is, we cannot say that it's entirely spending or the new spending priorities. So if the public debt has no fiscal cost, if your real rate of interest is not greater than real growth of economy, then it is said that it is not catastrophic. Your public debt or high fiscal deficit is not catastrophic, because the more debt he is getting justified by the clear benefits of reducing the output gap. But at the same time, you have to be very mindful of this difficult macroeconomic variable called output gap. And this output gap is, of course, the difference between your potential output and actual output. And actual output, of course, the GDP numbers you have seen, and it's a consumption-led growth. If you meticulously look at the GDP numbers, and it is no longer the narrative that it is an investment-led growth. We need to work for it to get it back to the investment-led growth, which is more sustainable than consumption-led growth. And the potential output is a way we calculate a series by taking out the cyclicality using this Kalman filter or HP filter, and to arrive at that potential, you call the trend component as potential. And there is controversy over this methodology. I'm aware of that. I have written about it, because the argument is that no economic recession is followed by a quick economic rebound or recovery. So if that is the case, if you focus just on the cyclicality elements of your growth process, then you may not get the growth recovery correct. That's why, if you look at the pandemic packages, the fiscal space, if you look at, we have designed the economic fighting packages to tackle the pandemic. At the same time, we have also floated some structural reforms in the country, including the labor reforms and the power sector reforms. And I have also written about the power sector reforms, with my colleagues in IPFP, Divirankan and Amandeep Kaur. You can take a look at that paper. What we have identified is that, of course, now the distribution companies are getting privatized. That's what is announced in the 2021-22 budget. But if you look at the parameters, the operational parameters and the financial parameters, you are still not getting the story correct in terms of your power sector reforms. If you look into the numbers, the financial parameters, the difference between what you call as your aggregate cost and your aggregate revenue receipt, that ACS ARR gap, that is widening across states. And another parameter, the financial parameter you need to correct, is to reduce your aggregate technical and commercial losses, AT&C losses. And the norm was 15%. But if you look at the cross-state data using the dashboard, there's a pass in the power mainstream. You get the dashboard for this, what you call the power sector reforms, and especially related to this Uday program. If you take a look at the numbers, they are not 15%. Aggregate technical and commercial losses further high, and you have not sufficiently dealt with the inefficiencies in the power sector. That's why the extra borrowing powers of the state government, now it is linked to the performance related to the power sector reforms. You can understand that the macroeconomic uncertainty, that's now getting, the states are getting equally exposed to the macroeconomic uncertainties. Earlier, the narrative was that if you look at strictly the theoretical models, in the three-tier model, in the national, provincial and local government model, macroeconomic stabilization was always the function of the center government. But right now, if you look into the cooperative federalism models in India, for the first time ever, we are nudging the subnational governments to equally, get into the markets and get their fiscal space corrected. So extra borrowing capacities will be given only if they correct their, the fundamental structural reforms, including the power sector reforms, and also the state governments and the subnational units are getting equally exposed to the macroeconomic uncertainties. So it is not like the center will face the uncertainty and devote the money. That is the entitlement of the states. It is not like that. The narrative has changed. Now, let's have a look into the budget numbers. What is a way in which center government has tackled the fiscal space or trying to enhance the fiscal space? On the one side, the taxes are not buoyant. On the other side, we cannot do expenditure compression because it will have adverse growth consequences. So what we have done is, what center government has visualized to increase the fiscal space was to go towards privatization measures to increase the fiscal proceeds. But if you look at the numbers, the privatization proceeds or the disinvestment proceeds, even if, our aspirations about the fiscal marksmanship is going to be perfect, what we aspire in our budget estimates, if there is no deviation between the budget estimates and the actual estimates, even in that case, it is around 5 to 6% of your entire revenue receipts. If you take the revenue budget and the capital budget, that is only 6% of it. So, we need to tackle the COVID related economics through the taxation path as well. But Indian government has not taken the taxation path to deal with the pandemic, in the sense we have not taken any initiatives to have a COVID tax to increase, the tax rate, or to increase the wealth tax, or to tax the rich people. That's what, the debate is getting into. Like, why don't you tax the top one class, what Piketty has called the top one class income class, and get the things done, rather than going for a fiscal austerity measure, seeing that we don't have money, so we have to go for expenditure compression, which can be detrimental, because this is a human tragedy basically. So in order to avert this human tragedy, and of course in the long-term economic recovery path, if you have to get back to the pre-recession or the pandemic level, we cannot go ahead with a fiscal austerity path. Now comes the question, what's an alternative if the privatization proceeds, the fiscal proceeds from privatization is not doing great, and if your R is going to be greater than G, if your real rate of interest may get above your real growth of economy, and the belief of yours that of course high deficit, high debt is good, but we will grow out of it. If you have to grow out of it, then your G has to be greater than R, right? Right now there is no crisis. But if you're not doing that, then the problem is Indian government has to go for an eventual monetization of deficit. But of course, that pressure is not right now there. But we can see that the corporate giants like, Kotak Mahindra, Nobel laureates like Abhijit Banerjee, they, and of course Professor Kaushik Basu, of course they have, given indication that monetized deficit, a re-emergence of monetized deficit is crucial. This moment to tackle, to finance your fiscal deficit and to protect the fiscal space required to deal with the pandemic. But the question here is, can we do that? And economists are divided in this case. And my director here, Professor Pinaki Chakravarti, he has spoken to the Press Trust of India, and that news you can see in almost all the major dailies. It carried that his point on Don't go for a monetized deficit this moment. Of course, there will be inflationary pressures and the pressure on currency. So his caution was that if the R is greater than G, then the case will be different. But right now, if you open that path, that can, be used as a tool to deal with your fiscal marksmanship. The moment your tax projected or the revenue projected and actuals, if it is not, if that deviation is huge, then there could be chances for a fiscal profligacy to go for print money and finance your deficit in future. If that, because that's what we dealt with in the late 80s. That of course it created inflationary pressures. The first mover advantage was always to the fiscal policy maker, and the central government was supporting by financing the fiscal deficit through ad hoc treasury bills. And we have gone through that difficult state and we have controlled that monetized deficit, and over the years we have gone from the monetization of deficit to bond financing. But of course there is a merit in the argument that there can be a finite MFFP, that is finite money financing of fiscal programs, if your R is greater than G. That's a caution. If the R is not greater than G, then you have what you call technically the free lunch or something like that. And here the problem is, it should not lead to fiscal profligacy. But at the same time, if you don't have any other avenues to enhance your fiscal space, of course, it's not the concept of helicopter money, dropping money into the hands of people, or a huge, macro fiscal stimulus package in the form of cash transfers to the hands of people, which Indian government has not done as a part of, economic stimulus packages, because the concern was, as, Rekuram Ranjan has pointed out, that instead of, spending, if the propensity to save for people is huge, then, it cannot stimulate the economy. But of course, these are times of livelihood crisis, and what government of India has done was that they have gone for targeted cash transfers. It's not like a huge, macro fiscal stimulus package in that sense. And the argument or the narrative here is how you tackle the pandemic. The narrative was, you believe in participation income, that is, giving opportunities for the people to participate in the economic activity and earn an income, or you believe in the universal basic income, in which you give a judicious amount of cash transfers into the hands of people. So in this process, what was given emphasis by government of India the moment we think about the fiscal stimulus package was that they have given importance to strengthening the government acting as an employer of last resort. But you can always argue back to me that if you look at the numbers, expenditure numbers of NREGA, why the allocation has not improved, why that's stagnant, or why it is unutilized. So these are the times of uncertainty. So if the moment you are not able to guarantee the job, can you give that cash transfer to the people, or you have to guarantee 100 days of labor, which of course you cannot find that in the times of crisis. So in the implementation stages, can we go for an articulation like this and give people money, whether the government is able to, or the state government is able to find that 100 days of job or not, but give people, is that the right way to tackle the process? So these are questions coming up, and we need to deal with these uncertainties. But the overall narrative, as Nirmala Sitharaman has spoken to Bloomberg, prior to Union Budget 2021-22, if you look at, what she said is, don't fear deficit this moment. If you fear deficit, it can have adverse growth consequences. So that's the way that we have floated that 9.5% of GDP this moment to tackle the economic crisis. But now the narrative that the economic stimulus packages, the fiscal stimulus packages, if it is entirely designed from the paradigm that economic growth matters and everything else over there, then there's a problem, because you have to be into a growth plus paradigm to face the humanitarian crisis that's happening in the COVID time. But if you focus just on the economic growth recovery, whether U-shaped or V-shaped, then you are not going to get your story correct. And even this output gap, that is based on the analytical framework that you believe in business cycles. in the context of an emerging economy. And if you look at the works of Geeta Gopinath, her co-authored paper with Mark, it is titled "Cycle is Trend." If you look into that paper, there is a concern there about dating business cycles in the context of emerging economies. You can't exactly date when it's a up, when it's a down, when it's a trough. You can't exactly date the business cycles especially in the time of recession or pandemic. So you need to follow up another analytical framework that is called as hysteresis. Hysteresis is dependent on economy, on history. So you need to focus on the hysteresis to get your growth story correct. And you also have to depend on the structural reforms, especially the banking reforms, your labor reforms, your power sector reforms, because these crises, this is also an opportunity to float medium-term reforms. So when you get both the component correct, then only you can deal with the cyclicality elements. Otherwise, you may not get your story correct. So these are the concerns. So maybe I will stop here and look forward to your questions, and I can fine-tune my lecture based on your concerns and questions. So over to you, students. I will listen to your questions. I will note down your questions and clarifications, and then I will try to, for the better time management, I will try to answer your questions together, and would love to listen to your voice now. Over to you, Professor Giri. Thank you. Yeah, go ahead, Banu. I think you are muted. We can't hear you. Good afternoon. Rajan? Yeah, go ahead. Thank you. Thank you. That's a brilliant question. Let me collect the questions from your friends and get back to you, because that case sheet, that inequality, I would love to, discuss, because, thank you for highlighting that. Before that, let me listen to the questions from your friends. Yeah. Okay, okay, absolutely. And thank you for highlighting that point, that the fiscal dominance of the fiscal stance, that may not lead to V-shaped recovery. There are issues related to economic inequalities. Thank you for highlighting that point. So you may not get V-shaped or U-shaped. You may get a K-shaped recovery in which the economic, inequality issues like unemployment, the redistributive issues, the poverty is mounting. There are, of course, migration related issues, the labor market crisis. So when these crises are real, when you focus just on the capital infrastructure spending, how you're going to get the growth correct. That's exactly why, Rajan, I mentioned about, the focusing of the narrative beyond the economic growth paradigm. We have to focus on the widening inequalities. So if you unpack the pandemic packages, not only in the case of India, we have done a study on the Asia Pacific countries' pandemic packages. When we unpacked the pandemic packages, mostly the component or the fiscal space was articulated to tackle the economic growth recovery. But if you look at the components which you mentioned related to the food security measures, related to the education and health, the social infrastructure measures, and of course we need to support the people with social protection measures and the employment policies, because the employment is plummeting, your wages are coming down. So these four components of the economic stimulus package, that is not significant, because the overall narrative in the package, what was that narrative was economic growth recovery without focusing much on the economic inequalities issue. And here, if you look at the center government, you must be aware of the narrative. You also mentioned that it's a credit-led, it's a liquidity infusion technique which we are focusing, and we are thinking that that's going to be a magical pandemic economics package or magical fiscal policy, but there is a concern. On the one side, you don't believe in enhancing the fiscal space using the fiat money. You fear inflationary pressures. On the other side, you floated the economic reforms or the economic pandemic package measures, believing that credit infusion will translate into the demand stimulation, but that's not exactly what is happening now. The credit is not the magical variable, and this also can lead to the problems in future, because bad bank and all we are talking about right now only after the global financial crisis, because we thought that is not a real issue at all and we sat over it. But right now, if you look at the works of Stiglitz and Rashid, they have mentioned that it is not only the liquidity trap that's going to be a concern. If you lower the interest rate and it's going to be zero bound and it's going to be negative and no longer it may trigger your economy, that's a different story. But this liquidity infusion can also give rise to another, opening the floodgate for more non-performing assets, or it's going to be a component which we need to cleanse in future. But at the same time, what we are focusing right now is this belief that the credit works. And you mentioned about the brownfield. Of course, recently there was a debate on how green can be our center bank. In that process of debate, if you look at the European Centre Bank, the chief, the Christine Lagarde, who was the managing director of IMF, she believes that greening of monetary policy reaction function is crucial. So the moment you think that your monetary policy function cannot deal with the climate change commitments, you are not able to go beyond the concept of price stability as the sole criteria of a centre bank. So here the economists are of course divided, and Raghuram Rajan's point was that if the centre bank gets into the crisis beyond the economic growth paradigm of the price stability, the issues can go little political. So the political economy question of tackling with crisis, that's a fiscal policy makers are better in doing that. That's what is stake. And he mentioned that, the moment you go for only green bonds, the moment you go for only green investment and forget about the brown investment, brown bonds, then there can be, little political economic question be on board, and that is crucially linked to the financial stability questions, investment questions, and also, your stability in terms of your price stability. So that's why he thought that that's not a good idea that a bank can get into this climate change commitments. But we need to wait and see how the climate change commitments, because this is closely related to the crisis economics, this issue. So we need to tackle. And in India, what we have focused so far is fiscal policy makers. The subnational and national governments are dealing with the national climate action plan and the kind of, climate responsible budgeting. We don't have the roadmap for that. The thought process is open. And at the same time, in the intergovernmental fiscal transfers, we have not designed a COVID grants or anything, but we have a formula-based fiscal transfers in which, the climate change is a part of that criterion, and ecological fiscal transfers for the first time ever in the world was supported by, Government of India or the Finance Commission. So these are real issues, that how we are going to tackle the inequality issues, climate change issues. And if we just focus on our growth recovery, as you rightly pointed out, as Rajan rightly pointed out, we may not get a V-shaped recovery. And second point is, of course, the business cycles may not operate, and your growth, the drop is a permanent drop in the growth. You may not get the growth back to the pre-pandemic levels the moment you work only with your cyclical elements. That's the point. And to me, the fiscal space, the major component has to be on investing in health related spending, because if you look at the numbers, it's only just 1% of GDP is your health budget. So you need to focus on the health budget, and the pharmaceutical interventions, vaccination procedures are very crucial. And unlike the global financial crisis of 2007, then economists could take decisions regarding growth recovery independently, and then the monetary policy stance was given importance for the as a counter-cyclical policy tool. But we missed a chance of what fiscal dominance can do over there, and we believe that the monetary policy transmission mechanism is going to create the growth back to the pre-recession levels, but that didn't happen. That's one thing. But right now, if you look at the difference here, economists and the medical professionals, they have to work hand in hand, because epidemiology of the virus is crucial to understand. And if you look at the SIR models, Divi Rankan and myself, we have written a paper on the COVID policy responses, the global uncertainty. And in that, we have looked into this SIR models. It's like the population is divided into three, like susceptible to infection, infected, and recovered. And of course, you can increase that model to SIR, Q, and E, like exposed to infection or quarantine, whatever it is. If you're going for just a epidemiological path without getting into the non-pharmaceutical interventions or economic variables, like what's the impact of the lockdown procedures, what's the impact of other policies, then the models are not perfect. So here there are a lot of uncertainties in coming up with the model, to predict even the path or the epidemiology of the virus, or even the peak or the non-peak, or even the variants. We are unable to do also because of two reasons. One is acquired immunity here is not permanent. Whatever you acquire through vaccination or once infected, you're prone to second chance. It is not, acquired immunity is not permanent here. So unlike the earlier cases, you cannot predict your models here. And also you need to understand, and you already know that a part of a segment of population, they are asymptomatic as well. So there are many concerns in going for these models, in predicting this as well. So given all these uncertainties, along with this policy uncertainty, whether we have to tackle inflation or whether we have to go for growth recovery, or as Rajan pointed out, these two components are not enough. We have to think beyond and look into the economic inequality questions to tackle the pandemic, and employment policy need to be given prior importance. So these are concerns, and we have to wait and see what is the next in the series of this mini budget packages in terms of your economic recovery package. But one thing is good, that is welcome, that we have not yet started normalization procedure, because the moment you start the normalization procedure by RBI, of course we know that there are repercussions in the monetary call money market. The rates are below the repo rate, and there are repercussions on the other end, that if you look at the securities market, the long-term bond yield rates are going haywire. There are issues regarding your term structure of interest rate. But at the same time, RBI has not gone for the normalization procedure. Rather, they focused on the infusion of liquidity. And you must also be remembering the operation twist, that is elongation of maturity structure of bond market, in order to clean the bond market so that our refinancing risks are postponed. That strategy of refinancing, methodology. That's what I mean is the RBI has gone into simultaneous selling and buying of bonds. Simultaneously, they sell the short-term bonds and buying the long-term bonds. That is the way they go for the elongation of the maturity structure. Because growth path, the recovery of the growth path is a major concern, and we have to go ahead with this. So these are the ways in which the RBI and the government of India, they maneuver the thing. And the only good news is that we have not yet announced a rollback of the economic stimulus packages. And Rajan, you have any supplementary questions to me? Yeah. Okay, Manrika, of course, that employment policy, that's very crucial, and we need to strengthen that. And that's why in my lecture also I mentioned, when you have the policy dilemma of, participation income and the basic income, I think you need to focus on the, participation income by enhancing the potential of, the government acting as an employer of last resort. I do take that point of yours. Thanks, Rajan. Yeah. More questions? Yeah, you are. Yeah. Thank you, Shantindu. The question, when we talk about the poverty, I think urban poor, that part is not extensively studied. You are right that when we talk about strengthening the employer of last resort policy, we cannot just focus on the rural. We have to be focusing on the urban poverty and urban poor. And I can't agree with you more regarding, strengthening an employer of last resort policy in the urban sector as well. I do take that point. And of course, the point you mentioned, that Abhijit Banerjee, in order to increase the purchasing power of the people, that's the crucial point which we need to focus right now. And those kind of demand stimulating programs, why government of India has not directly got into those aspects? This is a crucial question. And one is, we believe in the principle of subsidiarity. The decisions have to be made by the government closest to the people. So if you're believing in the principle of subsidiarity, in getting your purchasing power correct, correct, then there should be a steady flow of intergovernmental fiscal transfer also to the subnational governments, because many of these questions, if you look into the 7th schedule, many of these questions have to be handled by the subnational governments. But where is the fiscal space for the subnational governments? And of course, the tax uncertainties are there. And even the fiscal devolution, that is also not going to be so certain as per their entitlement. That's why I mentioned that in the cooperative federalism, it's the first time that we have experimented with this nudging process, that state governments are equally exposed to, the kind of economic uncertainties. So, in order to strengthen the purchasing power, of course, one thing they have indirectly done is they have not increased the tax rates. For COVID, direct or indirect taxes. So there was not a COVID-related cess or the tax rate. That thing has not yet happened. So that's a good thing. But on the other side, the expenditure priorities, and there is a huge expenditure compression when it comes to, when you articulate the fiscal space, and that can be detrimental for the economic growth recovery. So, if you ask me what could be the level in which you can trigger the purchasing power, maybe a limited, money financing a fiscal program, a limited seigniorage financing could be a way in which you can do that. If the concern is inflationary pressures, right now the economy is below the potential. But as I mentioned earlier, if your R is not greater than G, you don't have to, go for that, eventual monetization or anything. But if you have a crisis, then talking about expenditure compression is going to be detrimental. That's my point. Another way how you can enhance the fiscal space to tackle with the demand side stimulation programs. Another way is you engage in COVID bonds. Just like the way after Second World War, you have the bonds which is named as console. So that's what economists also argue for, a kind of COVID bonds to enhance the fiscal space. But we have not gone for COVID bonds, or we have not gone for re-emergence of the monetized deficit. What we have emphasized is on privatization. And from there the fiscal proceeds are equally uncertain. So in this moment, the narrative is whether credit-led supply-side pandemic economics can do wonders. Of course, no. We need to stimulate the macroeconomic, the demand part also, but we don't have any thing, just like the way Treasury Secretary Janet Yellen has designed for her country, that kind of 25% of GDP, that kind of fiscal stimulus program has not happened, and primarily it is because of lack of fiscal space. But you're absolutely correct, because credit can be partial, because you can give credit, but with that credit you have to generate an economic activity, and there should be a purchasing power for the people to own that products, right? So unless that happen, what's the meaning of this? Just the credit infusion, when you don't have any supportive policies for a demand. That question, even I do have doubts about these aspects. And of course I can't agree with you more regarding the urban employer of last resort programs. You have to focus on urban as well. And Shardendu, did I miss any point of yours? Thank you. Yeah. Thank you. And of course, Rajan mentioned about the disconnect between the real sector and the financial sector. I missed that point. That's crucial, because financial exuberance, that is a different story. And then, that cannot ensure that the real sector is going to do well. So in the real sector, the important macroeconomic variable is, of course, the public investment. That's what I feel. And, from that is the only perspective in which you can, what you call, you can substantiate the use of debt, that even if the high debts, we are using it for strengthening the public investment. But we have to wait and see, how far it's going to, pick up, because now if you look at the numbers, the states are of course doing the heavy lifting regarding the capital investment, and we have to see how the center government is going to do that. Yeah. Yeah. Mm. Mm. Thank you so much. Your first question is on inflation. Right now, as per the new monetary framework, that agreement between the government of India and RBI, inflation targeting, that rules based monetary macro is on board, and inflation is entirely controlled by RBI. But the questions like supply side shocks, how those kind of inflation can be controlled through the non-monetary policy framework, then the way RBI defended was that, of course, they have this unobserved variable, that expectations. Since 2021, they have the expectation survey, and through this expectations formulations and the expectations channel, even the supply side elements of inflation can be tackled by central bank. So inflation is not strictly a monetary phenomenon. So adjusting the repo rates alone cannot tackle the inflation. You have to get into the supply side, but through the expectations channel, RBI is able to control the inflation. So that's the take. But at the same time, economists also questioned, and that this is from 2016, the moment we got into this, after the Urjit Patel committee recommendations, we got into the new monetary policy framework. The question was that this inflation targeting itself can lead to a kind of a low equilibrium of economic growth, because it's not one-to-one relationship. So whether the economic recovery is not entirely happening, is it because of this inflation targeting framework? And we believe that the repo rates and the growth rates, that feedback mechanism, that's one-to-one, and it is of course not one-to-one. Is that the case? So this was one of the concerns, because if you look at the Dr. Y.V. Reddy's regime and all, monetary policy reaction function was like comprehensive. It was not just focusing on the inflation targeting, but it was getting into the regulatory mechanisms, it was getting into the exchange rate management, and about the impossible trinity. So there were a lot of things happening within the RBI. But right now, I was listening to the former deputy governor Mr. Khan's interview, and he mentioned that unknowingly we went back to that prior new monetary framework regime the moment COVID hit us, because it was not only through maneuvering the repo rates that we responded to the crisis. If you unpack the monetary policy packages floated by RBI, it has elements of many things other than just focusing on the price stability. For instance, they have gone into the regulatory mechanisms, they have gone into announcing many, as I mentioned in my lecture, many liquidity infusion methodologies. So all these things are very crucial. And here what is important is the monetary and fiscal policy coordination, rather than we believe in an unpleasant fiscal arithmetic regime in which central bank is given importance. That kind of regime we call as unpleasant fiscal arithmetic. Just like the way I mentioned, if R is greater than G, you have to eventually monetize your deficit. So that is unpleasant monetary arithmetic, because here the monetary arithmetic is unpleasant because all what you have is inflation today or inflation tomorrow, that kind of a flexibility. But inflation is going to be a reality the moment the bond financing that reach a stage in which your R is greater than G. So that's exactly what I want to highlight here. Even in the case of the COVID bonds, even if you ring fence in the bond financing that this is a COVID bond, even if you ring fence that, the bond financing cannot go beyond a point of R and R greater than G. So if the R is greater than G, you have to eventually monetize. So that's why, even if we shifted from the single-age financing to bond financing, inflation, we can control only till the moment that, your parameters of R and G is correct. Otherwise, you have to go beyond that. But COVID bonds are given emphasis. Bond financing is given emphasis in order to avoid the macroeconomic consequence of single-age financing of deficit. That is inflationary pressure, or even the currency, the pressure on the currency can happen. So that's why, the importance was given to the COVID bond. But if you ask me, the macroeconomic consequence depends on the way you finance your deficit. And if you go beyond any mode of financing, then there could be repercussions. If, like single-age can cause inflation. Bond financing can lead to crowding out of your private investment because you're preempting your loanable funds to finance your deficit. But in the context of India, what we have identified is that there is no crowding out. We don't have much evidence for crowding out. That dollar-to-dollar displacement, like if you increase $1 for your public investment, that's going to displace $1 of your private investment. That narrative is not working. Here what's working is it's crowding in, especially if that is in the infrastructure investment. So that's the way, and of course, deficit is not the villain anymore in increasing your interest rates. That's also another important point. There is no financial crowding out also, because inflation is based on the inflationary expectations framework, and that expectations is maneuvering that the process of inflation containment. It's not that if even the interest rates, like interest rate is also pegged as per the framework of inflationary expectations and the output gap. So here the deficit is no longer the villain in shooting up your interest rates. And also in an open economy, in the financial integration models, the rise in interest rate that can be spreaded out as well. And these are the concerns, these are the positive things the moment we talk about, bond financing. But beyond a point, that is not possible, because you have to get into the two crucial macro variables like R and G. If that is greater than, if R is greater than G, then you cannot go ahead with bond financing. So that's the point. Professor Giri, I have talked about the inflation concerns you have. Is it okay, or did I miss any point? I preempted your question. Okay. 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 Suchitra. Okay. Yeah, go ahead. Yeah, your friend Shardendo has asked the same question. You missed that, and I told that it can be done, but regarding this wage structure, the minimum wages and all, we need to work out that wage gap. So all what is crucial is to deal with revising the minimum wages, and of course that wage hierarchy we need to tackle the moment we talk about the urban employment opportunities. So other than that, I don't find any other issues related to in improving enhancing or strengthening urban the urban counterpart of the NREGA. So that's one thing. Second, when the government floated this labor market reforms, because when we talk about employment, this is also a crucial point. In the structural reforms package, labor reforms was a crucial component. But what we have done is that in that consultative process, it needs to be given an emphasis, because that tripartite consultation of government, management and the labor, the trade unions, whether that was okay the moment we decides on the labor codes and the other kind of details when we went for this labor reforms. So that was also a matter of concern. And of course, if you ask any heterodox economist what is the crucial component to get your economy back to the recession levels, her or his answer will be employment policy. There are several schools like Levy Economic Institute, as our friend mentioned in her opening remarks that I am also affiliated to Levy Economic Institute. That's a heterodox school of thought in New York. They believe also the Kansas school, and also you have a coffee school in Australia, and people belong to heterodox school of thought. They believe that employment policy is a prime concern, and employment policy is the magical policy component or the missing policy strategy to get the economic recovery. Otherwise, there could be two things. One is growth can happen with a lag in the jobs. That is a jobless growth, which happened even prior to pandemic. It's not new in the context of India or emerging economies. That can happen. So emphasizing COVID or no COVID, the emphasis on employment policy is welcome. So that's my take. Yeah. Thank you. Thank you so much. Absolutely, I would love to do that. And also please ask students to be in touch with me in my Twitter handle, or you can share my email address with them, and would love to meet them in your campus. And thank you so much. Thank you. Thank you. Bye-bye. Thank you.